Okay, let's unpack this. Welcome back to The Deep Dive, the show that takes, well, really complicated concepts, runs them through our sources, and distills them down to what you really need to know. And today we are tackling, I think, the single most foundational principle in all of finance. It's the time value of money. And it really starts with a simple question, a thought experiment. Why is getting $100 today always, and I mean always, a better deal than getting that exact same $100 a year from now? Feels obvious, right? But the rules behind it, compounding, discounting, those govern everything, absolutely everything, from huge corporate mergers right down to how you plan your own retirement. So the mission for this deep dive is, well, to make you an expert on this, to understand how to compare money across different timelines. Because that's the thing, cash flows are almost never a one-time event. Let's use an analogy right out of the gate. The fruit tree analogy. Imagine someone offers you a fully grown fruit tree. You can have it today, or you can have the exact same tree a year from now. If you take it today, you get the fruit that's on it right now. But, and this is the crucial part, you also get the tree's ability to grow more fruit next month, the month after.
You get the engine of growth.
Exactly. Waiting a year means you forfeit all that missed fruit.
Yeah.
And that missed fruit, that's your interest. That's your return.
That's a perfect analogy. It immediately brings up opportunity cost and risk, for that matter. Formally, TVM is just. It's the idea that the same amount of money has a different value depending on when you get it. And this is the one thing you just can't get around.
Yeah.
You cannot directly compare $100 today with $100 in 5 years.
They're just not the same thing economically.
Not at all. You have to convert them, bring them both to a common point in time, usually today, to do a real apples-to-apples comparison. Otherwise, you're just guessing. And, this isn't some newfangled Wall Street idea. Our sources show this goes way, way back. We're talking Mesopotamians, Egyptians, as far back as 5000 BC.
Really? What were they doing?
They were charging interest on loans of, like, seeds or olives, even animals. And the logic was it was beautiful. If I lend you seeds today, I'm giving up the chance to plant them myself and get a whole harvest.
The missed fruit?
The missed fruit. So I deserve to be compensated for that lost opportunity, that compensation. That's interest. It's ancient.
Okay, so let's dig into that idea of the foregone return. It's not just about, wanting to spend the money now.
No, that's part of it, the preference for current consumption, but the bigger piece is the investment potential.
Right. It's about putting that capital to work immediately. Let's just put some numbers on it. Say you get $1,000 right now. You put it in a savings account. Maybe it yields 6% a year.
Okay.
In just 1 month, that becomes about $1,005. If you agree to get that $1,000 30 days from now instead, you've literally just given up that $5.
And the chance for that $5 to start earning its own interest.
Precisely. That tiny amount is the engine of compounding. It's the cost of waiting. Now, for any of these calculations, whether simple or, super complex, there are always 4 things you have to know. 4 essential parameters.
The building blocks.
Exactly. First, the cash flows themselves. The present value or future value. Second, the rate of interest. The compounding or discount rate. Third, the time period, amming. And fourth, and this is a big one, the frequency. Is it compounding yearly, quarterly, monthly?
Get those 4 inputs right, and you can solve almost any TVM problem. And it really comes down to 2 inverse relationships that you have to understand. First, the impact of time. This is the intuitive one. The longer you have to wait for a cash flow, the less it's worth to you today.
So $100 in 5 years is worth less than $100 in 1 year.
Much less.
Yeah.
Because you're missing out on 4 extra years of that compounding opportunity.
Yeah.
That time variable and in the formula is a huge value killer the further out you go.
And the other relationship?
The impact of the rate, the discount rate. This is where it gets really interesting. The higher the discount rate you use, the lower the present value of that future money.
And that rate isn't just a random number, right? It reflects your own opportunity cost.
Exactly. A high discount rate means you have really good investment options elsewhere. You're giving up a lot by waiting for this specific payment. So you discount its future value much more heavily.
Let's run a comparison. Say you're promised $1,000 guaranteed 3 years from now.
Okay, scenario 1. You're a pretty conservative investor. Maybe your required rate of return, your discount rate, is 5%. You run the numbers, you discount that $1,000 back to today, and its present value is $863.84.
So that's the most you should be willing to pay today for that future promise.
Correct. Because if you invest that amount at 5%, it'll grow to exactly $1,000 in 3 years.
Okay, now scenario 2.
Now, let's say you're a growth investor. The market's giving you 8% pretty easily, so your discount rate has to be 8%. You run the same calculation. That same future $1,000 is now only worth $793.83 today.
Wow, that's a huge difference. Over $70.
It is. And that $70 gap isn't a penalty. It's the extra money you could have earned by investing at 8% instead of 5. The higher your opportunity cost, the bigger the economic penalty for waiting.
So we've got these two main tools then. Future value for looking forward and present value for looking back. Let's start with FV compounding.
The fun part, watching money grow.
Ha, right. So future value, FV, is just what will an amount I invest today be worth at some point in the future? It's the basic tool for any kind of financial projection.
And the formula is that classic FV equals PV times 1 plus R to the power of N.
But the devil is in the details, right? In that R and N.
This is where people get tripped up.
All the time.
Let's use an example. Say an 8% annual rate compounded quarterly over 5 years. You can't just plug in 8% in 5 years.
No, you'll get the wrong answer, a wildly wrong answer.
You have to adjust. The rate becomes 8% divided by 4, so 2% per period.
And the number of periods N becomes 5 years times 4 quarters, so 20 periods. If you don't make that adjustment, you are leaving a ton of money on the table in your calculations.
And you're missing the whole point of compounding, which is that interest on interest effect.
The snowball?
The snowball. The interest you earn in the first quarter immediately starts earning its own interest in the second quarter. That's the magic. Actually, can I just mention a quick mental shortcut here? The rule of 72.
Oh, good one. Yeah.
It's a great little trick. You just take the number 72 and divide it by your annual interest rate. It tells you roughly how many years it'll take for your money to double.
So at an 8% return, 72 divided by 8 is 9. It'll take about 9 years to double your investment.
Exactly. It's a fantastic back-of-the-envelope calculation.
Okay, let's look at a really clear example of this. The Krishna example. He invests $500,000 for 5 years at 8%.
Right. And we'll look at 3 scenarios. Scenario 1 is simple interest. This means Krishna takes the interest out every year. He earns $40,000 and he spends it, maybe on tuition, whatever. The interest never gets reinvested.
So after 5 years, he's earned 5 times $40,000, $200,000 in interest.
Exactly. His final value is $700,000.
Yeah.
Now, scenario 2, annual compounding. This time, he leaves the interest in the account. It gets added to the principal and earns its own interest. At the end of 5 years, his maturity value is $734,664.
So an extra $34,664 just from letting the interest ride.
Purely from interest on interest. Now for the crucial part.
Yeah.
Scenario 3, quarterly compounding.
The same 8% annual rate, but now it's calculated and paid 4 times a year.
We use our adjusted numbers, 2% for R and 20 for N. The maturity value jumps again. It hits $742,974.
Okay, so that's another $8,310 more than the annual compounding.
It is, and why? Just because the interest started compounding on itself sooner and more often.
Over a 30 or 40-year retirement plan, that small difference in frequency becomes astronomical.
Hundreds of thousands of dollars. That's not a small detail.
Okay, that's a fantastic illustration. So let's flip it. Let's talk about Part B, discounting and present value. PV.
Bringing the future back to today.
Exactly. If FV is about projecting forward, PV is about calculating backward. What is the value today of some amount of money I'll receive in the future?
Which is the core of all valuation. Stocks, bonds, real estate. It's all about discounting future cash flows.
And the formula is just the reverse of FV, right? PV equals FV divided by 1 plus R to the power of N.
Yep, so let's run a quick one. What's the present value of $50,000 that you'll receive in 5 years if your discount rate is 6%?
So you take 50,000, divide it by 1.06, raised to the power of 5.
And you get $37,362.91.
So getting 50,000 in 5 years is the economic equivalent of having just over 37,000 today, if you can earn 6%.
Correct. The difference, that nearly $13,000, is the cost of waiting. It's all the interest you missed out on.
And as we said before, the longer you wait, the bigger that discount, the lower the present value.
Absolutely. Now, a single cash flow is one thing, but most of finance deals with a stream of regular payments, what we call an annuity.
Like mortgage payments or rental income.
Exactly. And for that, we use a specialized annuity formula. It saves you from having to discount every single payment one by one and add them all up. Let's use the Shyam example. He's going to receive $6,500 a year for 8 years. His discount rate is 7%. He wants to know the lump sum value of that today.
So he's asking, what's this whole income stream worth in one single number right now?
Precisely. We plug the numbers into the annuity formula. C is 6,500, R is 7%, N is 8. And the PV comes out to $38,813.44.
Meaning, if someone offered him that lump sum today, it's a fair trade for his 8 years of payments, assuming he can reinvest at 7%.
You got it. And for anyone using a spreadsheet, the PV function does this for you. PV rate and PMPMT.
But again, you have to be so careful with the inputs. If the payments are quarterly, you have to use a quarterly rate and the total number of quarters.
And you cannot forget that type of argument at the end. 0 for payments at the end of the period, 1 for the beginning. It seems like a tiny detail, but it can change the valuation by thousands of dollars. We'll see that later.
Okay, so we know how to move money back and forth in time. Now let's talk about measuring how well an investment actually did. The rate of return.
The scorecard.
Right. We need a standardized percentage so we can compare different investments. If we know what we started with, the PV, what we ended with, the FV, and how long it took, we can solve for R.
And the formula is just a rearrangement of the FE formula. R equals the nth root of FE over PV minus 1.
And when we're talking about periods longer than a year, the gold standard for this is the compounded annual growth rate, CAGR.
Yes, this is the one that matters. HER is the single, smooth, average annual rate of return that would have gotten you from your starting point to your ending point.
It smooths out all the volatility.
Exactly. It ignores the crazy up and down years and gives you one number that represents the true underlying compound growth. It's the only way to make fair comparisons.
Let's make that concrete.
Okay, simple one. You invest $100, and in 2 years, it's worth $120. The CAGR is 9.54%.
So it's as if you earned 9.54% each year, compounded.
Correct. Another one, a mutual fund. You buy it at a price of $10.50, you sell it 3 years later at $12.25. The CAGR is 5.27%. Now you can compare that to its benchmark.
What about those messy, real-world holding periods, not exactly 1 or 2 years?
Great question. This is where standardization is key. Say you held something for 450 days. In the formula, N isn't 1 or 2. N is 450 divided by 365, about 1.23 years.
So you're always converting the time period into years?
Always. If we run the numbers on an investment that went from 11 to 1350 in those 450 days, the CAGR comes out to a very precise 18.07%. Now it's comparable to everything else.
This brings us to a really critical point, and one that trips up a lot of people. The difference between a simple average and this true compound rate.
Ah, yes. The arithmetic mean versus the geometric mean.
Explain that. The arithmetic mean return, AMR, is just the simple average of each year's returns.
Easy to calculate and often very misleading.
The geometric mean return, GMR, is the same thing as CAGR. It's what actually happened to your money.
And then the key thing to remember is that the geometric mean is always, always less than or equal to the arithmetic mean.
Let's use that extreme example that really shows why. A portfolio that goes down 50% in year 1.
A disaster.
And then up 100% in year 2. A huge rebound.
Okay.
The simple arithmetic average is easy. Minus 50 plus 100 divided by 2. It gives you an average return of 25%. Sounds fantastic.
It sounds great, but it's meaningless. Let's follow the money.
Right. You start with $1,000. Year 1, you lose 50%. You're down to $500. Year 2, you gain 100%. But it's 100% of that $500. So you make $500 back. You end up right back where you started at $1,000.
Your total growth over 2 years is 0. So your true compound annual growth rate, your geometric mean, is 0%.
0%, not 25. The GMR tells you the reality. The AMR tells you a story.
And that's the whole point. The GMR correctly accounts for the impact of that volatility. The arithmetic mean just ignores it.
So when would anyone ever use the arithmetic mean?
That's a fair question. It has some uses in high-level financial modeling for predicting future short-term returns. But for looking back for evaluating past performance, CAGR is the only honest metric. And just to add another layer of sophistication here, for portfolio managers, there's another distinction: time-weighted versus money-weighted returns.
Okay, this is important. TWRR versus MWRR.
TWRR, the time-weighted rate of return, measures the performance of the fund manager's decisions alone. It strips out the effect of when you, the client, decide to put money in or take it out.
So it isolates the manager skill.
Exactly. But the MWRR, the money-weighted rate of return, measures your actual personal return. It's highly sensitive to the timing of your contributions and withdrawals. If you have great timing, your MWRR can be better than the fund's TWRR.
So TWRR is how you judge the manager. MWRR is how you judge yourself.
That's a perfect way to put it.
Okay.
Okay, let's get into the really practical day-to-day stuff. Loans and savings. Calculating that periodic payment, the EMI, using the PMT function.
Essential for budgeting.
Absolutely. You need the rate, the number of periods, and the loan amount, the PV. Let's use the Satish house loan example. $300,000 loan, 6.5% for 20 years, paid monthly.
Monthly, so you have to adjust everything.
Everything. The rate becomes 6.5% divided by 12. The number of periods, NPER, becomes 20 years times 12 months, so 240. You plug those adjusted numbers in and get a monthly EMI of $2,236.72.
And the sensitivity here is amazing. We saw that just a 0.25% drop in the interest rate.
From 6.5 to 6.25.
Saves him about $44 a month, which doesn't sound like a lot.
But over 240 payments, that's over $10,000 in interest saved. Tiny rate changes have a massive impact over long periods.
That's the power of time working against you, in a way.
It is. And it's also worth noting that these loans are front-loaded with interest. In the first few years, almost all of that $2,000 payment is going to the bank as interest. Only a tiny fraction is reducing your principal.
A painful truth. Now, what about the flip side? Figuring out how long it'll take to pay something off. That's NPER.
Right. NPER calculates the number of periods. It's a great tool for financial advisors to show a client, look, if you can pay this much per month, here's exactly when you'll be debt-free.
Or when you'll hit your retirement goal.
Exactly. Say you have a $50,000 loan at 8%, and you can afford a $1,200 monthly payment. NPER will tell you that you'll be done in 48.97 months. It makes the goal concrete.
Okay, let's circle back to annuities for a second. You mentioned that type variable was really important.
It is. It defines the two main types of annuities. The default is an ordinary annuity, where the payment happens at the end of the period.
Like a bond coupon.
Exactly. The other is an annuity due, where the payment happens at the start of the period.
And you said the annuity due is more valuable.
Always. Because you get the money sooner. Each payment has one extra period to be invested and to compound.
Let's run those numbers we talked about. $5,000 a year for 4 years at a 10% rate.
Okay. For the ordinary annuity, payments at the end of the year, the present value is $15,849.
And for the annuity due, payments at the start of the year.
The present value is $17,434.
So difference of over $1,500.
Just by getting the cash flows one period earlier. Over a 30-year retirement, this isn't a small thing. It's a significant amount of wealth you're leaving on the table if you structure things as an ordinary annuity.
Okay, one last type. The weird one. The perpetuity.
Ah, yes. The cash flow that never ends, it goes on forever.
Does this actually exist?
It does, in things like some government bonds, preferred stocks, or for valuing very stable, mature companies that are expected to pay dividends forever.
And the valuation is surprisingly simple.
It is. Because time is infinite. The formula just simplifies down to PV equals C divided by R, the annual cash flow divided by the discount rate.
So a perpetual bond that pays $10,000 a year in an 8% interest rate world is worth...
$10,000 divided by 0.08, $125,000. That's his value today.
Okay, let's get into some of the more advanced, nuanced applications here. You mentioned something called the cost of rest.
Yes. This is a subtle trick some lenders use. It's about when they calculate the interest. Normally, when you make a monthly payment, your principal balance drops, and next month's interest is calculated on that new, lower balance.
That makes sense.
But with an annual rest, even though you're paying monthly, they only recalculate the interest on your principal once a year.
So for the whole year, you're not getting credit for the principal you've paid down.
Exactly. Your principal balance stays artificially high for 11 months of the year, so you end up paying more in total interest. It's something to look for in the fine print of a loan document.
That is sneaky. Okay, now let's apply all this to bonds. We have to understand compounding frequency.
Right. A bond that pays its coupon semi-annually is more valuable than an identical bond that pays annually.
Because you get half the money sooner.
You get it sooner, and you can reinvest it sooner. It's that annuity due principle again. This is why we need to calculate an effective yield, or APY. It converts everything to a standardized annual rate so you can make fair comparisons.
And we also have to talk about how bond prices react to changes in market interest rates.
The inverse relationship, it's pure TVM. If you own a bond paying a fixed 3% coupon, and new bonds are suddenly being issued at 5%.
Your bond looks pretty bad in comparison.
It does. So for anyone to be willing to buy your old bond, its price has to fall. It has to drop to a level where that fixed 3% coupon payment provides the new buyer with the market's required 5% yield.
And this risk, the risk that rising rates will hammer your bond's price, is what sophisticated investors measure.
They do. And the metric they use is the most advanced concept we'll touch on, Macaulay duration.
Which is not the same as the maturity date.
Not at all. Macaulay duration is the weighted average time it takes to receive all the bond's cash flows in present value terms. It's a measure of the bond's interest rate sensitivity.
So a bond with a higher duration is more sensitive to rate changes.
Much more sensitive, it has more risk. For a portfolio manager, managing duration is how you manage interest rate risk. It's the ultimate application of TVM in the fixed income world.
Okay, so let's try to bring this all together. We've built a pretty powerful financial toolbox in this deep dive.
We have.
We've learned about compounding and future value, how to project growth, and crucially, how adjusting the frequency is key to that interest on interest magic.
Yep.
We learned about discounting and present value, the tool for figuring out what any future cash flow is worth today, the heart of valuation. We established that CAGR is the only honest way to measure long-term investment performance, and we saw how misleading simple averages can be.
Critical lesson.
And finally, the practical tools, PMT and NPER for managing loans, for managing debt, and for setting real, time-based financial goals. You really do now have the knowledge to look past the surface of any financial product.
You understand the cost of waiting. You understand the power of time. And that is a huge advantage. And, we spent a lot of time on Macaulay duration, on how it's the key metric for managing the risk that changes the nominal interest rate posed to your bonds. So that leads to a final provocative thought for you to take away from this. If Macaulay duration is the tool for managing interest rate risk, what is the equivalent metric you are using to manage the risk that inflation will destroy the real purchasing power of your life savings? Duration measures sensitivity to nominal rates. But how are you quantifying and actively managing your portfolio sensitivity to the real-world erosion caused by inflation? That is the ultimate application of the time value of money over a lifetime. Something to think about.